ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. David Lennox, resource analyst at Fat Profits, joining in. Welcome to the show, David, and a pleasure to speak to you as always. David, my first
Hi, Hiral.
coming to you is overall, if you see in terms of where the commodities market is concerned, we've started to see a lot of pressure now, especially with what's happening globally, the way the dollar has been moving. What's the sense that you pick up?
Look, one would certainly have to suggest that when you have a look across the commodity suite, we have seen that pressure coming primarily from the US dollar. It continues to push towards record highs. And that's because if you have a look at the peer currencies that it's up against, they're unfortunately all going in the other direction because of various reasons within their own economies. So the US dollar's been playing a safe haven for many investors. And with that, we've seen, unfortunately, it's been very difficult for commodity prices to any form or extent rally, and that's what we're seeing. One would have to suggest, however, that given where we are seeing that US dollar at record highs, the US dollar index, then the commodity space is probably doing pretty well. We would have expected perhaps see much lower prices, but there certainly is some underlying strength in the sector.
Right. So overall, that's the overall view. Now, interesting moves that we are seeing is with regards to where crude oil is concerned. You have crude which has fallen below the $85 per barrel, and this has happened for the first time since January. Where are we headed according to you?
Look, one just has to look at what's happening in terms of in China with the potential for continued lockdowns there, and that country certainly going into economic disruption. So that's a problem that certainly can chew through demand very quickly. But the real concern now is that we're going to see perhaps a global recession, and some commentators are already calling that we are perhaps in one already. And with that, one would expect to see considerable destruction of demand. And the markets are very quickly building that in. We saw the crude prices tenaciously holding on around the $100 level for a while. But now that we've, I guess, definitely got the severe case of recessions coming on, we've seen that demand starting to really be priced in, and the prices have followed it accordingly, and that's down.
Right. So overall, this morning as well, I was hearing, David, that Russia is likely to propose that OPEC Plus goes ahead and reduces oil output by almost around 1 million barrels per day, and this will be done at its next meeting in October. Similarly, if you go to see overall with regards to the backdrop of falling oil prices and months of severe market volatility, which has prompted another two of OPEC plus producer Saudi Arabia also to go and say that the group could go ahead and cut production. Do you see that happening? And if that happens, do you see that supporting crude oil prices from here on, and we will see a bounce back?
Oh, look, there's no doubt about it. If we do see OPEC go through with, instead of winding back cuts, in fact, they're introducing them again, that is going to put some very good support underneath the oil price. And one would expect with that type of announcement that we would see the oil price bounce higher. It will be a matter of whether or not they actually do go through with that. We are well aware that they are probably not quite so comfortable with the oil price down where it is at the moment and would like to see it higher. So it will only take a matter of probably cutting, as you say, that amount of barrels out of daily production, and we will see that oil price bounce. The big problem is, will they do it? One would have to suggest that OPEC's been pretty good over the last couple of years with keeping some sort of promises, and one would expect that if they are feeling some pain, we will see that very quickly translate into production cuts.
Right. Moving away from crude as well, what's your view coming in with regards to where natural gas goes?
Look, I guess we've been well aware now of what's happening with Europe in terms of the gas flows into that particular part of the world, or the lack of, and that's really been the driving factor. It has pushed up the requirement for Europe to seek other sources of energy and other sources of natural gas. And of course, that then ripples across the rest of the supply chain. So with natural gas now, we are starting to see, I guess, a little more of a more uniform approach to the logistics problem. as time drags on, one would expect that the markets will get used to the changes in supply. But at this point in time, we still are coming on to probably quite a cold northern winter. And if that's the case, then we will see significant pressure on the gas prices.
Right. And overall, the next in line is what we're looking at in terms of the US house data as well as the core PCE inflation. What's the kind of impact we could see, especially in terms of metals and commodities as a whole is concerned?
Look, one would expect if we do see a further deterioration in those metrics, then we would expect to see the US dollar remaining at where it is at these record highs. And that will continue to put any rally in commodities in check. But as I've said already, there is some underlying strength in those commodity markets. You only have to have a look at the LME inventory numbers, and they continue to show I guess, a downward trajectory, which would suggest that there's being inventory pulled out of the LME. If that's the case, then supply must be at this point somewhat short of demand across a number of those commodities. And if that's the case, then we can't see the commodity prices collapsing completely. Throw in that some countries are already considering quantitative easings and further quantitative spendings, and that could really put somewhat of a very good support underneath commodity prices.
Right. And overall, do you think gold also can get out of its price downtrend when probably the Federal Reserve realizes that it can't control inflation the way it needs to?
Look, there's no doubt about that gold is suffering the case of the high US dollar as well. If we see the Federal Reserve continuing to push rates higher, then that's going to give that interest rate differential in favour of the US dollar, and it's going to keep that dollar higher and the gold price, unfortunately, to the downside. The only saving grace is that if we do see a continuation of sticky inflation higher than perhaps the 2% target for some time that the Fed's aiming for, that will give some confidence to traders, and that will put a support under the gold price. However, it's been the US dollar that's been the king over gold, and that's going to be the continued case. We do need to see some of those other currencies now starting to pull their weight on the upside. And if that's the case, then we will see that US dollar roll over. But unfortunately, till this point in time, we've got that wrong. We thought it would roll by now, but it continues to stubbornly remain high.
And with regards to silver as well, what's the view? Because clearly the strength in the dollar as well as the rising bond yields have continued to punish the precious metals.
Oh, look, yes, there's no doubt about it. Silver, unfortunately, is more leveraged to the industrial process than gold. And if we do see a recession start to settle in across the globe, then, of course, that means the industrial process is slowing as well, and that the physical demand for gold will start to slow. Throw on top of that the problem that gold's got with that high US dollar, no different for silver. Then you've got a double whammy for silver. It could be well leveraged to the downside if we do see a recession settle in and we continue to see that US dollar heading for record highs over the course of the next few months.
Right. And very lastly, David, with regards to base metals as well, similarly, the pressure has continued. There is again pressure coming in from the dollar, the bond yields, as well as if you see in terms of the demand as well, specifically with regards to what's happening in China. Do you think that pressure will continue? And if that does, what should an investor do now?
Well, look, certainly if you're watching China, we're well aware now that their property sector is well and truly in a mire, and values being lost there considerably. That means that construction activity in that sector is dropping away as well, and that will feed into demand. However, you've got to have a look at the other side as well, and the government there is already taking action to stimulate various parts of its economies. And we do think that with infrastructure spending, that will certainly help to perhaps maintain a more stable base for commodity prices. It may not stop them from falling because, ironically, like gold and silver, they face the problem of that high US dollar. But we do think that there's probably a good chance that we could see a greater recovery or a faster recovery in the base metals if we see China continuing to stimulate its economy. And in fact, I guess the damage from their property sector is somewhat limited. That could really surprise the market to the upside and we could see quite a strong rally in commodities. At the moment, that's not likely on the cards, but certainly it's something that one would be watching. So I would be very cautious at this point if I was an investor, but I would certainly be nibbling on the dips as they come along. And if I can't pick the bottom, I'd be happily averaging in until I can see a more clearer picture and the markets turn around.
Right. So overall, that's the view. So, David, my last question coming to you is, would it be right to say that for the next 3 to 6 months, or maybe slightly longer than that, we could expect to see further weakness in overall commodities market as a whole, and this could be a time to sell on rise versus, buy on dips?
Look, certainly that's could be a possibility, but you've got to have a look at what the Federal Reserve's doing inside the US. They've been lifting their cash rates at outsized numbers, more so than we've ever seen in the past. So what that means is that we're going to get to a slower point in the economy much quicker than we have in the past. So if that's the case, then the markets are going to really start looking outside of or beyond what's going to happen with the recession once it starts to recede. So if we continue to see those outsized interest rate increases from the Fed, that's going to slow their economy much quicker than it would have in the past. And really, that's then going to focus the market's attention on, well, what happens once we get to the low point in the recession and we start looking at the other side. That could probably take 4 to 5 months, but we certainly do think that by 2023, we'll be looking through and beyond the recession and looking at what's going to happen in the next solid up phase.
Absolutely. So I think it's going to be a precarious situation from here as well, and we need to wait and watch as well. So thank you, David. Thank you so much for joining us on the show. Always a pleasure to speak to you, get insights from you. Thank you. Stay safe and speak to you soon again.
Thanks, Hero, and the same to you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.